All right, welcome to the Explainer. Today, we're cracking open the 2026 roadmap for implementing Slovenian language support and accounting compliance right into osFinancials and TurboCASH. So think of this as your ultimate developer's blueprint. We aren't just talking about translating a couple of drop-down menus here, we're talking about completely rewiring the core accounting engine to handle Slovenia's incredibly rigorous, legally mandated compliance structures. Seriously, if you're building financial software for the European market, wrapping your head around this architecture is absolutely non-negotiable. Here is our game plan for today. We're going to cover 1. Linguistic foundation, 2. Compliance frameworks, 3. Sole trader logic, 4. Corporate taxation, 5. Ledger architecture, and finally 6. VAT mapping. Let's jump right in. Section 1. Linguistic foundation. We have to nail down these parameters before we even think about touching the accounting engine. To get the underlying translation architecture working flawlessly, you need to hard-code a few very specific parameters. The Slovenian language, or Slovenština, uses the two-letter ISO 6391 code SL, the three-letter ISO 6392 code SLV, and the absolutely crucial locale code SL-SI. Nailing this right from the start ensures that everything, from the way dates are formatted to currency symbols, integrates perfectly for users no matter what operating system they're running. Moving on to Section 2, Compliance Frameworks. Let's talk about SAS versus IFRS and how they shape the initial setup. So picture this. A new user boots up the software to set up their company profile. Right out of the gate, you need a conditional fork in your code based on the size and type of the business. If the user selects micro or small entity, your system has to default the reporting standard to the Slovenian Accounting Standards, or SAS. But if they classify as a public interest entity, like, say, a bank or a publicly listed company, the software must enforce the International Financial Reporting Standards, or IFRS. The cool thing is, Slovenia doesn't actually force IFRS on small and medium enterprises, so keeping SAS as that default for smaller users is a huge, critical detail for an intuitive user experience. Section 3, Sole Trader Logic. This introduces a major fork in the road for tax calculations. Okay, this is where localization gets genuinely complex. Your software has to handle a massive divergence in how calculations are run for individuals. A sole trader, which is known as an SP in Slovenia, does not pay corporate tax. They pay personal income tax, but they get to choose between two radically different ways to calculate their tax base. Your software needs entirely distinct modules for this. You've got option A, which is the normalized expenses regime, and then option B, the actual expenses regime, which relies on standard double or single entry bookkeeping. Now, here is where it gets really interesting, and honestly, it's kind of like a developer's dream. Under the normalized regime, there is an 80% flat, standardized expense deduction. Instead of forcing users to painstakingly track every single coffee receipt, the state just grants an automatic 80% deduction on revenue right off the top. The software then just calculates a 20% flat tax on that remaining 20% slice. Mathematically speaking, the effective tax rate drops to just 4% of total revenue. For this, your software basically just needs to track incoming revenue against strict state caps, like the €72,000 limit for full-time sole traders. But let's say the user exceeds that €72,000 revenue cap, or maybe they just have really heavy overhead, like rent and a bunch of employees, so they opt for the actual expenses regime. Now, the software must trigger a progressive personal income tax scale. It has to take the net profit, which is revenue minus all those actual documented costs, and apply these progressive brackets. They start at 16% and climb all the way up to a hefty 50% for profits that go over roughly €82,000. Section 4, Corporate Taxation. Let's look at capital companies, where the business finances are totally walled off from personal finances. For corporate entities, like a limited liability company or a DODO, your software has to handle a two-tier tax application. It's a 1-2 punch. First, the tax module applies a 22% corporate income tax directly on the entity's accounting profit. Then, you need a secondary trigger. When that after-tax profit is actually distributed to the individual shareholders as dividends, the system has to automatically calculate and hold back a 25% withholding tax. Another huge detail here, whether your user is running a solo SPI or managing a larger DOO, the payroll module has to respect the social cap. You've got to ensure that your calculations for Social Security contributions, so we're talking healthcare, pension, disability, hit a hard, non-negotiable ceiling at a €7,500 maximum monthly base. Any salary base that goes above that amount is totally exempt from further social contributions. This is a vital logic gate to build in so you don't end up overtaxing top-tier talent. Section 5, Ledger Architecture. We are stepping into the engine room now with the 10-class decimal system. So this 10-class ledger structure is absolutely mandatory for double-entry bookkeeping under Slovenian standards. Classes 0, 1, 2, and 9 form the structural backbone of the balance sheet, and your setup needs to map everything precisely to them. Think of Class 0 as handling the heavy lifters, long-term assets like buildings and equipment. Class 1 is tracking liquid cash and short-term receivables. Class 2 manages your operating obligations, like supplier payables, usually within a 12-month window. And finally, Class 9 anchors the equity, share capital, and long-term provisions. When we move over to inventory, the rules get strict. The software has to completely isolate production materials from trading merchandise. Raw materials belong exclusively in Class 3, while finished goods and trading merchandise are parked over in Class 6. But then you have Class 5, which is essentially an open sandbox. It's kept available for optional internal cost accounting. This lets management track expenses by functional divisions or very specific production cost centers without messing up the primary outward-facing financial statements. And then operational logic dictates the income statement. It works chronologically. Every single operational expense gets captured in Class 4 first. Then, as goods are sold, those revenues are tracked in Class 7. At midnight on December 31st, your software's year-end routine has to kick in and mathematically match those Class 4 expenses against the Class 7 revenues inside the Class 8 clearing account. That is how you isolate the final net profit or loss. Finally, Section 6, VAT data mapping. Let's connect all this architecture to the National Tax Portal. Now, this is where all that rigorous ledger setup really pays off for the end user. If your developers map specific general ledger sub-accounts directly to the national DDVO return boxes, compliance reporting goes from a massive headache to being fully automated. I'm talking about setting up GL account 2500 to capture 22% output VAT and hard-coding that to flow straight into box 12 and 22 of the tax return, or mapping account 2520 for intra-EU acquisitions directly to boxes 13 and 23. Doing this is exactly what transforms a generic piece of software into a true localized powerhouse. So what does this all mean for you? Take these exact technical specifications, everything from those specific ISO language codes right down to the VAT mapping, back to your development team, and ask yourselves, is our core logic truly ready for the Slovenian market? Because when it comes to European localization, near compliance is literally just non-compliance. Thanks for hanging out with us for this explainer. Now get back out there and start building.